In this section, we're gonna look at the balance sheet part of it. The profitability we have already seen quite a much. Usually you can go into the details of the company's balance sheet, company's Excel analysis, and then you can ask a bit of more details. However, there's nothing much and it's already explained in the management account. Now let us look at the balance sheet healthiness of the company. So here you can see the working capital has already been calculated by the company, but let's say we can calculate that again. Or you can calculate the current assets to work the current ratio of the company. So normally the ratio analysis, to get the liquidity analysis, you need to calculate the current ratio, the quick ratio. And how you're going to calculate that? The current ratio is current assets divide by the current liabilities. That's the broad calculation of current ratio, and in this case is 1.36, which is okay, but from the general perspective, normally it's supposed to be 2, but here is 1.36 and 1.54. But it's not bad so far as it is not less than 1, right? But always need to compare it with the industry. Then you have a cash ratio, which is a quick ratio. Again, you're gonna calculate the cash ratio by using only the cash plus the marketable securities, because you can treat them as cash equivalent, divide by the total current liabilities. So here you are getting it 0.35 and 0.41, which means the company's cash is only 35% of what they are supposed to pay. But if you look at into deeper details, all the current liabilities are not really immediate, right? Some of them are commercial papers, some are term debts which may be due, may not be due immediately. Then there are other current liabilities. We need to look at the details of this. How much is really the immediately payable or payable on demand? These are not payable always on demand. There is a credit limit, there's a credit dues which is normally required, and then only you are paying. So the company may be able to manage the cash flow. So it's not really illiquid in that sense. Then normally we calculate the turnover ratios. So we calculate the average daily sales, and average credit sale, average cost of sale, to calculate the inventory turnover and working capital turnover ratio. So the net sale is divided by 365, and the next year is this one, and the average cost of sale is this. So this is what is the information. Now we can calculate what is the AR average turnover, AR days, right? So the AR days is usually calculated by account receivable divide by average credit sale, average daily sale. It's 21 days and 32 days. So average the account receivable that the company is holding is only 21 days and in 32 days. So company is able to collect the account receivable quite fast. Then you have inventory. Unfortunately, inventory, they have inventory. Okay, so how much is inventory holding days? So inventory holding days is usually, you can calculate inventory holding days divide by the average cost of sale. So 8 days and 9 days. So Apple is holding its inventory for 8 days and 9 days. However, you need to be careful here that average daily sale is including of all the product segments. It includes Apple, it includes Mac, it includes wearable, it includes the services. So in order to get really the AR days and also the inventory holding days, we need to look at the segment by segment. So how much account receivable belongs to to iPhone, how much is belong to Apple, how much is belong to the services. Similarly, in inventory, how much is belong to the phones, how much it belongs to the Macs, how much is belong to the wearable devices. And then only we will be able to really identify what is the holding days of each product segment, so that we can make a better judgment how many days the company is holding the inventories. Maybe iPhone is more, wearable are very less, or the Mac is less. So we cannot know that unless we get that data, but unfortunately that data is not really available in our hands. So that information you need to find out from the company itself. The only choice that we have is to ask that information from the company and the financial departments. So as a financial analyst, as a due diligence, we may be able to find that, but as an investor we may not be able to find that information. So we have to rest our decision only on the broad figures that we are able to get from the balance sheet. There are many other ratios that we can calculate, which I have explained in my class on the financial ratio and analysis. You can take that class to learn more about the ratio and how to detect the manipulations in the balance sheet and the profit and loss statement. But to continue with this class, usually because we are teaching only the methods how we analyze the information here. So the key, we're gonna calculate the key ratios here. Then the next ratio we normally calculate is AP days, account payable days, which is again quite a important consideration. So here the AP days is the account payable divided by the average cost of sale. So which is 90 days, and 104 days means the company is holding their suppliers for 90 days to be able to pay them in anything. So which is quite a long time, but Apple can do it because they have the bargaining power of the then the average cash conversion cycle normally, which is AP days plus AR day, inventory days plus the minus the AP days, is minus 60 days and minus 62 days. So means the company is does not have to spend anything to generate the cash, is actually using the suppliers money, is living on the suppliers money, which is fine for the company, not for the investors, but for the company is fine, right? Then you have non-trade receivables. So now let's look at some of the balance sheet items which may not be explained very well, and where to get that particular information. Now the question that arises in our mind is, the cash, converted cash and marketable securities are clear. What are vendor non-trade receivables? Are they actually receivables? That information you will be able to find only in the 10K reports. So the 10K reports, we're gonna look back at the 10K, and then we're gonna draw down into the balance sheet. So here you have the balance sheet and the statement of cash flows. So we will look at the cash flow in the next video. For the time being, let's look at the balance sheet items. So here the company has explained what are the cash and cash marketable securities, the inventory, property, plant and equipments, non-marketable securities. Then you will see the disaggregated revenue, or this one we have already seen the information. Cash and cash flow, marketable security, where the cash is being invested, derivatives. The schedule for the balance sheet should be here. This is trade receivables, other current liabilities. The schedule for notes on the consolidated financial statement details are there. However, the information on the other vendor liability and on the vendor assets is missing. So that information is not here, right? So you can see that the other trade receivable is there. The company has non-trade receivable from certain of its manufacturer vendors, resulting from the sale of components to these vendors who manufacture, sell sub-assemblies and assemble final product. The company purchased these components directly from supplier. As of company had two vendors that individually represented 10% or more of the variable, which accounted for 57 and 11%. Company has two vendors that individually represent 10%, which accounted for 59 and 40. So there are two vendors which the company has sold them their items. So the company's business model is that it's selling its products is sub-assembled parts to the company. They assemble and sell them back, right? So that's how it is working. So the dues that they have is actually the due which is pending for the assets, actually the worth of inventory that is lying in the hands. So if you see that, then our cash holding ratio actually is going to be different. So now we get a more information about the company. So means this vendor non-trade liabilities is actually the the inventory which is holding. So when we are calculating the inventory holding days, what we should do actually is we should plus the non-inventory days here, here this non-trade accounts. So we need to add this one, right? And then you will be able to see the inventory holding days of the company is about 54 days and 60 days. It's not 9 days. So it's a one way to hide the inventory, right? Because you have given the inventory to somebody and you are taking it out of inventory and putting into the other non-current assets, vendor assets. So when you are comparing with the other company who may have a different business model, means they are holding all the inventory in their hands, they are doing the processing by themselves, the Apple's inventory turnover ratio will always stick out because it's the way it is structured. But when you combine the two things by understanding the business model, then you will be able to get a clearer picture, right? So here it is. Now the companies normally also hide the other their account receivable in other areas. So we don't know what is the detail of other current assets here, which is quite a lot of amount, like $11 billion and $12 billion. We don't know about that because the 10K report is not giving that information here, unfortunately. So we don't know what that information is. So we have to kind of leave it as it is because we are not able to find that information. Then you have usually the other non-current liabilities. Okay, non-current liabilities we'll talk later. Now the other thing is the long-term marketable securities, which is the details is given. It's nothing much. You can only see that the company where the company is investing this money into. Then the property, plant and equipment is explained well here. It normally includes land and building for probably their head office and headquarters, then machine, equipments and internal use software 75B and 69B, leasehold improvements 10B, and the depreciation is already up to 66 billion. Means the two-third of the life of the land and building and the machinery has already gone. There's only 1/3 left. So the company would need probably some very soon to replace that thing, right? So you may be able to look at, okay, the company may need to replenish the machinery, replenish the equipments that they have. So they need to hold the cash reserve so that they can actually replenish it faster. So that explains why the company is keeping the money into the cash and cash convertibles. That's one thing. Then the next item that you have is the other non-current assets, which is again not explained. We don't have the details of other non-current assets, unfortunately. Here, as you can see, there is no details of that. So we will not know what that asset is unless we have the information. So we kind of have to rely on the company to get this information from them. Then only we will be able to comment or identify. Usually the companies try to hide a lot of balances which are not really recoverable, or related to to have a better ratio analysis into these different type of lines. So the company, so as a financial analyst, you need to find that details. The company is not explaining anything in the 10K report, which is not sure why they are not doing that. Right now, let's look at the accounts payable side. Payable, we have already seen the turnover ratio for payable is 91 and 104 days, which is pretty high compared in the industry for the holding payment of 3 months. But you need to look at the other companies, what they are doing, so you can calculate these ratios for the other companies, and then you can really calculate how much is the ratio for other companies. Then other current liabilities has been explained, which is given into the ratio here. So you can check them, and then you will be able to find. So then you are able to look at the deferred revenue. Now the deferred revenue means the company has got the advance, since they are doing the cloud services, so it's kind of makes sense, not really a problem. The company has also some commercial papers and term debts, which, looking at the cash pile of the company and marketable securities and their investments, raise questions why the company is still keeping the commercial papers and term debts, because on one side you are paying interest, on another side you are putting the cash in the bank, which is maybe the marketable securities, the market return the are much higher than the commercial papers. That's why the company is keeping the trade securities. But it's hard to explain why the company is still keeping the things in their hands. Then normally you have to look at what is the interest portion that the company is paying on these commercial papers and term debts. That information usually should be available in the 10K. So where you can see the 10K is there any information available? Cash flow, hedges, net investment. Sorry, the debt value is account receivable. Here, income tax, liabilities, deferred tax liabilities, tax positions. So it's not really giving that much of information on the debt here. So commercial paper is there. The commercial paper interest rate is 0.62% and 2.24%. Average interest rate of the commercial paper in as of 2020 and 2019. So 2019 was 2.24% and 2020 was 0.62%. Now 0.62% is quite less compared to the interest rate that you can get in the market probably. That's why the company is still keeping the commercial papers. And then company has also entered into agreement to sell the marketable securities with a promise to repurchase them at a specified time. Repos due to the company's continuing involvement with the marketable securities accounted for its repo as centralized borrowing, entered into $5.2 billion of repo during 2020, all of which has been settled as of 15 September. And then you have the long-term debt. So the term debt, again, it's $106 billion, and the interest rate here is, effective interest rate is 0.6% to 1.39%, and the fixed rate is 0.28% effective interest rate in 2020, and the amount is $2 billion and $87 billion. So this is the interest that is lying there, 98 billion and 91 billion dollars. The company here, this one. So we are not given any information about this term debt. Some part of the term debt is $8 billion is here, current portion. So it's a part of the total term debt which is due in this year. That's why the amount is here. The rest of the information is given there, so means the company is holding quite a huge sum in term debt. Now the effective interest rate is 0.6%. the company has used this money into into investment into marketable securities and also in the marketable securities here. What is the interest that the company is earning from the marketable securities? So let's look at that into the schedule of the marketable securities. The cash and cash level here, you can see that they are investing money into US Treasury securities, US agency, some commercial papers, commercial corporate debt securities, into cash and cash equivalents. So what is the interest rate? The interest rate on the US Treasury is variable. So you need to look at the interest that the company is paying on the term debt and also what the company is earning on the marketable securities. If it's not really a match, then you don't really have to worry about it. If it's the fact, maybe the net rate is not that much, but that information is not available in the things here, so it's very hard to understand. But if you want to understand, if you want to look at the impact on the P&L, you can see the net income on expenses is only $800 million and which is reducing quite a lot. So you can see if there is any breakup of the other commercial papers, other assets. There is no details on the other income and expenses, which is quite sad. Yeah, there is no information on that thing, so we cannot understand what is the interest income that they are earning and what is the interest that they are paying. So it's just difficult. Okay. Well, that's all mostly the information is which is available into the from the profit and loss statement, requiring from the coming from the 10K report. The rest of the data which we need to analyze, we have to find the information by ourselves from the external resources or from the company itself. So we are not able to understand practically what is the detail of other current assets. Actually, we don't know about that. There is no information on it. Then we don't know about why the company has marketable securities and other securities while also having a debt. Then what are the other non-current liabilities? We also don't know. Then other current liabilities we know. Okay, that's fine. So we don't know about these things. Then the rest of them is pretty much we know what are these liabilities and how they are working. Right, so that's about the balance sheet and profit and loss statement. So some information you may have to find from the company, and some information you will be able to understand. You can get some more information from the statement of cash, which is you can see on the screen now. Especially on the financing part of the company. So you can say here how much is the interest in financing activity, means what is the interest that they are paying. So you can see here, oh no, there is no information on the interest. It's just only the proceeds from the sale purchase of the connection non-marketable securities. Proceed from insurance. Normally the interest is also shown separately. How much interest is being paid on the repayment of term debt and also the common stock. So since that information is not really available on the face of profit and loss statement, or either here if what is the amount that the company is earning from the marketable securities or US treasuries, and how much money the company is paying on the term debt. That information is not very clear on the face of profit and loss statement. So we are not able to understand the impact that it is making on to the profit and loss statement. So we have to find further information, or have to seek further information from the company itself. So this is how pretty much you are going to analyze the this is how pretty much you're gonna understand the company's financial statements. These are the steps, and then these are the ways how we diagnose the potential information which is not available on the 10K reports. So there is certain information which is readily available, but we have to go beyond the 10K. Here in this case, we have seen the 10K does not have certain information which is important for the user to understand the operating performance of the company in a much deeper and detailed level. For example, it does not include the detail of the liabilities and does not show the impact of the interest earned and interest paid on the debt, which is important for user, but it hides that information into the profit and loss statement. Now, as a user of the company, as a user, you can ask the company these questions. If you are the shareholder, the company is bound to give that information to you because that's the requirement. But since we are not shareholder, we are not able to ask. But I hope you have already now understood. Now the next step will be the presentation part of it.